This is America in 2009.
Getting kicked out of your house.
I want to stay. I tried to fix with the bank, but they don't help me.
And when the day comes, it happens fast.
It's not just a house. It means so much to all of us.
Things are going to be much worse than anyone anticipates.
Wall Street's gambling and greed had led to the deepest financial crisis this century has seen, and it had echoes all over the world. And just a decade later, we had 2020.
We are going into a global recession.
We're in an economic downturn.
There's this fear that we might find ourselves in another crash.
But COVID came with another side effect. Home prices have skyrocketed over the last few months. And the dream of owning a home, which became a possibility for many families, many millennials, is evaporating with this overwhelming demand for homes, which has driven the price up. And it isn't a game. It's people's dreams and people's livelihoods. So is the current real estate market a reflection or a warning of what happened in 2008? I'm one of those millennials, by the way. I'm one of those millennials who needed to come into this game of mortgages and real estate to find a way to come out alive. So I bought my first condo in around September last year, and in one of the worst moments of the pandemic, and I had to sort of learn and adapt and understand how all this worked. And I'm gonna save you some headaches and explain it back to you. I was like 20 years old when the housing market crash happened in 2008, but I honestly didn't used to pay a lot of attention to the news. I was getting my digital animation degree, I was in Costa Rica, and we felt some of the ripples, but by no means experienced what happened in the US and in many other countries. I love playing Monopoly. We bought this board as a prop for our video on bankruptcy maybe 6 months ago. And I figured that we needed to get another video out of this board before defiling it by actually using it to play. So this is happening finally. So let's start with the basics. Most people won't have the full money, the $120 needed to buy a house, Connecticut Avenue. So they'll need to borrow that from a lender. So let's say the dog here wants to buy Connecticut Avenue from Cowboy. Dog, after saving for all his life, he can come up with a down payment of 60. But the other 60, they need to come from the bank. So the bank can lend him the other 60 so that they can together pay Cowboy and own the property, Connecticut Avenue. In exchange for that, the dog will continue paying the bank monthly installments, monthly interest payments until the debt is settled. Executing a mortgage means that the lender sells the asset to collect the missing debt, which is pretty simple because of the down payment. 20 or 30% of the debt is covered from day one, so they could liquidate that asset fast. They don't need to sell it at market price, and they still recoup the money that they loan. Now, in the world of investing, putting your money on Bitcoin is probably at the very, very extreme of this speculation and gambling. Anything could happen with that. We made a video about it. But on the other extreme is this boring certificate of deposit, which yields about 0.001% a year.
You give it to your snot-nosed kid when he turns 15. Maybe when he's 30, he makes $100.
For institutional investors, putting money in mortgages is a relatively safe bet because who doesn't pay their mortgage?
Who the hell doesn't pay their mortgage?
Millions of Americans don't pay their mortgages.
Also, if they actually don't pay their mortgage, you can just take ownership of the property and you're covered for the debt. So in the 70s, legislation was passed to allow lenders to pack these mortgages together into something called a mortgage-backed security. So mortgage-backed security is essentially thousands of mortgages all bundled together into a single security, which is something where people can invest in. And this is a decently cool investment. It pays well, it pays better than a single mortgage, and it's also pretty safe because it's thousands of mortgages all bundled together. If one or two people don't pay their mortgage, they're still covered and the security still makes money. So for the next couple of decades, mortgage-backed securities fueled the development of American housing, but it also filled the pockets of banks and Wall Street investors. And they got greedy. More investors wanting to put money into these securities means more money available to lend. But there are only so many families or so many individuals who want to buy a house who have a perfect credit record. So requirements started loosening up so they could get more mortgages in. So this meant that your credit score no longer had to be perfect, and you could still get a loan. Their required down payments decreased as well. And to make up for the risk, those weren't 3% 30-year mortgages like they used to. These individuals got offered subprime loans, which is a loan that has a low fixed interest rate for a few years, and then it spikes up to a much higher interest rate. That's adjustable, meaning it changes based on different market indicators. And all of that money flowing also led to a boom in housing. Fancier houses in bigger residential complexes all over the country. Not only that, but houses themselves increased in value. buying a house became this short-term investment because its value could go up 20 or 30% within a few months. And then naturally, people wanted to take advantage of these conditions and buy more than one house as an investment, each with a separate mortgage. While this was all happening, Wall Street investors doubled down on their bets, quite literally doubled down. This gets a little complex, but essentially banks took bets on their bets. They package these mortgage-backed securities into bundles called CDOs, and then they took loans to buy more of these assets. And they insured these securities using an instrument called a credit default swap, which allowed some investors to make money if the security failed, meaning if people didn't pay, they would actually make money because the mortgage failed. It's like an inverse security. It's like shorting the mortgage bond. So investors took bets on bets on bets. But the first bet was this mortgage that someone took on a house with an inflated price, on a low down payment, on a subprime loan, on a salary that probably wasn't enough to pay the loan. Now, if you can't afford to pay a loan, then the owner of the mortgage needs to sell that asset, needs to sell that house to recoup the capital that they loaned, right? But suddenly all these extra houses that they had been built were all back in the market all at the same time, and nobody was buying them. More supply and less demand means that prices drop. So suddenly that asset was not enough to cover the mortgage. More so, you might have a mortgage on a house that cost you $700, but is now worth $200. So you owe the $700 to the bank, and you're struggling to pay the interest on that, but the house is not worth what you're paying for. So you just prefer to walk. As people couldn't pay their mortgages, lenders started going bankrupt. The banks that had insured the mortgage-backed securities with these credit default swaps didn't have enough money to pay either, so they went bankrupt as well. And it's like a chain reaction. The stock market plummeted. That left a lot of people unemployed, which left more unpaid mortgages and more chaos. Now, before I move into the 2021 housing bubble, I want to talk about today's sponsor, which is ourselves, Kinda. This week we launched Recurring, which is a tool to track your company's SaaS tools. We built it because we needed it ourselves. We pay around $40,000 on recurring subscriptions on SaaS tools, and QuickBooks is just not efficient to keep track of them. Recurring tracks all of your company's subscriptions. It warns you about spikes in price, and it tells you which platform may have duplicate functions compared to other platforms that you're already paying for. And all you have to do to make it work is forward your invoices to us. You can connect your books too, or your email, but only if you want. And companies with under $5,000 in monthly subscriptions can use Recurring for free, forever. And after that, it's just $29 a month. So check out Recurring at recurring.co.
Home prices in the U.S. have climbed at a record pace during the pandemic.
A dramatic acceleration in home price growth to levels we haven't seen in decades.
Now, the median home price in the U.S. reached an all-time high earlier this year. Now, that is higher than 2008, just before the bubble burst. And things got pretty crazy earlier this year. Bidding wars on home buyers, fighting for the few houses on sale in the market. A simplistic look at this situation could drive us to the same conclusion, right? There's a new bubble approaching. But the reality of today is actually quite different. It's not Wall Street gambling or speculation. Thankfully, I think we learned a lesson and regulated some of that after 2009. So the first thing you'd need to do is look at mortgage rates, which are lower because of the various stimulus the government has approved to keep the economy active. So pre-pandemic, March 2020, the average interest rate for a mortgage was 3.45% on a 30-year loan. And that dropped to 2.9% by July 2021, which means getting a mortgage on your new house is now cheaper. On a $240,000 house, for example, this interest rate means that you pay $1,096 instead of $1,161. So you can use that extra $70 or so towards a bigger house and a bigger mortgage. Secondly, various studies agree that the US has underbuilt houses over the last 20 years, apparently by 5.5 million houses. This means that there's a smaller supply of houses combined with this higher demand. And this higher demand comes from various factors also associated with the pandemic. Many people chose to move to a house, a single-family home, because they now work from home and they want some extra space. They also spent a year stuck at home, and if they kept their jobs, that means they had fewer expenses, less travel, and a couple of $1,000s in stimulus checks. So these are people who might have considered buying a house in the next few years, in the next 2-3 years, and they're moving faster and doing that today because they now have the cash. And so many experts have called what's happening now a housing boom rather than a housing bubble. Prices are definitely being driven up, but it's by a higher demand and a lower supply, which is a magic combination to increase pricing on something like Supreme or toilet paper. Naturally, though, after 2008, people don't trust Wall Street very much. And why should they? So if you're buying a house, maybe you should wait? Ignore me, don't mind me. Who am I to say, well, this is ridiculous? The point is, most experts agree it's normal, dare I use the words, healthy capitalism. Just like selling t-shirts on YouTube. Thanks for watching. Let us know what you think in the comments, and we'll see you next week.